한테 조금씩 나와주셔서 대단히 고맙습니다. 사실 오늘 401 세계무역연구원 이사장께서 오늘 사회를 해주시기 때문에 경제위원회 회의가 있어서 Please join me in welcoming Dr. Pozen with a big hand.
Sovereign wealth funds are definitely an institution, UBS, and they also include Merrill Lynch, where the Korean fund helped buy some securities to recapitalize Merrill Lynch. What do you want to do this? Okay. So, it's surprising, given all of the capital that has flowed to American institutions, how much criticism there has been of sovereign wealth funds. And this criticism has come not only from American policymakers, the criticism has come from Europe. And in response, we hear almost every day a new reform proposal. They want to make sovereign wealth funds abide by a code of best practices, or say that sovereign wealth funds need to have more transparency. So I will first start off by reviewing some opinion data, survey data, about what are the perceptions of sovereign wealth funds in the United States, and then I will go on to analyze the realities of sovereign wealth funds in 5 main areas: the source and size of sovereign wealth funds, their projected impact on the capital markets, concerns about their intruding into security and political matters, concerns about their intruding into disclosure and market stability, and lastly, issues of protectionism and reciprocity. So let me begin with this slide, which shows you a recent survey that was done among Americans. Now, one of the incredible things about this survey is that Americans actually know very little about sovereign wealth funds. In the survey that was taken, only 6% of the respondents said that they had seen or heard anything recently about sovereign wealth funds. And given the amount that sovereign wealth funds have been in the news, these people are not particularly knowledgeable about what's going on in the world, which is typical of the average American. Yet, they have strong negative feelings against sovereign wealth funds, even though they know very little about them. If you look at 72% say that the sovereign wealth funds do not disclose enough about where and how they are investing. And we will look at that later as an empirical question. 68% say that when sovereign wealth funds buy shares, that may give them too much power in the United States. And 67% say that when the sovereign wealth fund buys shares, this may compromise Western national security. And this same sentiment we hear in Germany. Mrs. Merkel has said that state-owned funds can have political strategic aims that could be problematic in sensitive areas. She added, this is a new phenomenon that we must tackle with some urgency. And Mr. Sarkozy says, there's no question of France remaining unable to react in the face of this rise of power of extremely aggressive sovereign wealth funds. France must protect the companies and give them the means to develop and defend themselves. So these are pretty strong feelings being expressed. So, building on those feelings, let's see what is the reality. Now, the first thing we should know is that sovereign wealth funds have been around for quite a few years. They've been around for 20 or 30 years, and most of them were begun by countries at the urging of the IMF in order to diversify and stabilize the flow of oil, which they were heavily dependent on. In fact, 2/3 of all sovereign wealth funds derive most of their money from oil. So if you look at this chart, you don't have to be a mathematical genius to realize why sovereign wealth funds have done so well recently. Between 2000 and 2006, the net capital outflows of these countries, the oil-producing countries, was $1.7 trillion. This is much larger than any amount in prior years. Obviously, it has to do a lot with the price of oil at over $100 a barrel. So this is one of the factors that is driving the growth of sovereign wealth funds. The second area that drives the growth of sovereign wealth fund, more relevant to Korea, are the large trade surpluses which are growing up in mainly the Asian countries. These figures are the annual trade surplus for 2007. As we can see, China leads the way, Japan next, and other countries in Asia also have significant surpluses. What has happened is that these countries have transferred some of these new surpluses and started the sovereign wealth fund. In China's case, which has the largest reserves at 1.4 trillion, it's transferred 200 billion to its sovereign wealth fund. It already has a social security fund that invests for the government. Korea, as well known in this room, started a sovereign wealth fund in 2005, funded it with about 20 billion US dollars, and latest time I looked, Korea had foreign reserves of 247 billion. So that's the second source. Now there is also a third source, and that is there are some countries that have used sovereign wealth funds to invest in Social Security, and these include Canada, New Zealand, Singapore. So these are countries that have used sovereign wealth funds to invest in the markets. So we have three basic sources of sovereign wealth fund. And you can see them right here on the map. Let's see if you can see that the largest are the commodity oil funds led by UAE, Norway, Saudi Arabia, Kuwait, Russia, Libya, and that the others are what I call trade and pension funds. Singapore with its two funds, China with its two funds, Hong Kong and Australia. In total, the conservative number for sovereign wealth funds at the end of 2007 was 2.5 trillion. Some people would say it's a little higher, but I'm a conservative guy, so I'll say 2.5 trillion. Now, the key thing that has happened in the last year, which is in fact the stimulus for all this discussion, is we have what I call global role reversal. In 1997-98 scenario when Asia had its financial crisis, the Western countries came to the rescue. Now, the U.S. and Europe are having its financial crisis, and most of the money to bail out these financial institutions is coming from the emerging markets. In general, we think industrialized countries export capital to the emerging markets, but here the emerging markets, with the exception of Norway, are the producers of oil, and they are the trade surplus countries. So these investments have been very positive for the West, and they grow out of the desire of these countries to get a better risk and return and to help recapitalize this country, these individual broker-dealers and banks. But I think it is these purchases, over $100 billion in the last year, that have stimulated the debate. Now, let us, having essentially reviewed what we know so far about sovereign wealth funds, let us now go into a more difficult area of what we can project in terms of the growth of sovereign wealth funds and their possible impact on capital markets. I will say as a preface, especially for those of you who are professors of economics, it's a bit speculative, and we're looking at first-order effects because we know that second-order effects will be important. Nevertheless, I think it's helpful to get a sense of an order of magnitude. Here I am starting at 2.5 billion, and I am making the assumption that, as in 2007, there will be roughly 728 billion of new reserves added to the system. Now, these countries, you could argue that the number would be greater or smaller, but my assumption is that every country here, whether it be an oil producer or a trade surplus country, is already over-reserved. That is, they've overreacted to the Asian crisis by having more money in reserves than they need to defend its currency. So I am not assuming that it's going to take its existing reserves and transfer them to sovereign wealth fund. But I am assuming, because these countries are already over-reserved, that the new incremental reserves will be transferred to sovereign wealth funds. So if this happens, if we start at 2.5 trillion, and we add 728 billion in reserves every year to the end of 2015, and we assume a very modest return of 5% or 7% a year, we get to something like 11 or 12 trillion dollars by the year 2015. So my calculations are in fact consistent with calculations that have been done by other people. Everyone has their own methodology. But I think it is a fair statement to think that these funds will have roughly $11 trillion in the year 2015. Now, we have to understand, in sort of thinking about the critique here that's coming out, is this a rational investment move for these funds? Or is this some sort of geopolitical strategy? And the answer is clearly that it is a rational economic move. If we look here, these funds have been in Treasury. Over the last 5 years, Treasuries have gotten roughly 3% a year. Meanwhile, the stock index got 17, and a bond, 60-40 global bond, is at 13. And this is true over longer periods. So I think it is fair to say that governments are wanting to get a better return on this huge buildup of reserves, especially when they get beyond the point that they need them to defend their currency. Of course, a treasury portfolio would be a less volatile portfolio from year to year, but that does not really make a big difference here, because these sovereign funds are investing over 20 and 30 years time horizons. So year-to-year volatility is not that important. And I will suggest that over time, a sovereign wealth portfolio might look like this. This is just a modeling exercise. 50% in stocks other than emerging stocks, 20% in bonds other than emerging market bonds, 6% in emerging market stocks and bonds, 6% in alternative investments, 6% in commodities, and 12% in real estate. That is the sort of portfolio that we see in the few sovereign wealth funds where we actually know exactly what their allocations are. Yes, there can be increases and decreases. So we need to think about, what are the implications of that for the capital markets? Now this chart, that should be trillions, 55 trillion global stock. If we say, okay, sovereign wealth funds are going to have $11 trillion, and 60% will be in stocks. So that's about 6.6 trillion. And the question is 6.6 trillion over what? Now, we see the current stock market global capitalization is valued at somewhere between 50 and 60 billion. And I'm using 55 billion as a midpoint. So the question is, will the stock market be growing between now and 2015? Will it be contracting or stay the same? For those of you who are in the investment business, you should realize that the stock market has actually been contracting over the last 5 years. It's been contracting because of a combination of mergers, buybacks, and other factors that have both offset the IPOs. So I am just making a model assumption to say that it will stay the same over this period. And so you can see that over this period, it would roughly have somewhere in the area of 10% of the stock market. Now, is that a good thing or is that a bad thing? The answer is we really don't know. Well, one possible hypothesis is this. If you look at the demographics of the industrial world, we are getting older and the population is moving away from stocks into more fixed income. Meanwhile, the population of emerging markets is getting younger. So some people could argue that this influx in stock comes at the right time as Americans start the baby boom generation. Europe starts the baby boom generation, which starts about 2011. Now, let's look at bonds. Again, we can see that bond returns for AA bonds, that's the lower one, and for high yield bonds are significantly higher than the U.S. Treasury. And I think that we can predict, as money flows to sovereign wealth funds, it will not go into treasuries, but it will go into a diversified portfolio of higher bond yielding securities. Now, I am again estimating that 20% of sovereign wealth funds will go into non-government, non-emerging market bonds. So that's about 2.2 trillion in 2015. And then I have to make some assumptions about where the bond markets will be. And all I've done is basically taken their last 5 years of growth and extrapolated that. All these three bond markets have roughly doubled in the last 8 years. And so if we assume that they will double again, then they will get to those amounts. And if we make these assumptions, we can say that sovereign wealth funds will have roughly 10% of the non-government corporate market, 9% of the securitized market, and 7% of the high yield market. Now, emerging market stocks and bonds I've kept in a separate category because this is an area where most U.S. and European managers have been very shy, and we only see somewhere in the area of 3% of pension assets in emerging markets and bonds. Now, this has been the greatest category as an investor. If you were in emerging market stocks over the last 3, 5, 10 years, you were an investment genius. How many investment geniuses do we have here? Many. So it was a good asset category, and bonds were very good. Sovereign wealth funds are likely to be, in my view, have a total of 6% in emerging market bonds rather than 3%, because a lot of them are located in emerging markets, they're much more comfortable with emerging markets, and so I think that they're going to have more emerging markets in these sovereign wealth funds than the normal pension investor. And if we run out some of these numbers and we assume that 5% of the sovereign wealth funds will be in emerging market stock, that comes to about 10% of the outstanding stock in 2015. And if you assume 1% in emerging market bonds, which is a much smaller market, that would be about 12%. Another area is alternative markets. And I think we know that alternative markets have been favored by various sovereign wealth funds. They seem to like to invest in them. They felt pretty comfortable with them. So here we have some gross statistics that were done by somebody else as to where these are going to be in 2012. The 2012 sovereign wealth funds will be about $7.7 trillion. And depending on what assumption you make the assumption that 6% will be in hedge funds, so that's 450 million. So that would be a little over 10% of hedge funds, and if you say 3% will be in private equity funds, again, that'd be about 10% of private equity funds. Now, you know, I warn you that all of these assumptions are somewhat speculative, partly because they're going out 5, 10 years, but partly because they will have internal reactions on rates of return. If rates of return go down in emerging markets, bonds, or go down in hedge funds, people will obviously go against them. Just to make things a little more humorous for you, I mean, we've gone in the United States and in Europe from roughly 1,000 hedge funds to 10,000 hedge funds in 5 years. Now, I have a law, Pozen's law, which is totally without statistical support. And it says, in every generation of investors, there is the same exact percentage of investment geniuses. And I doubt whether that number all of a sudden went up in 5 years from 1,000 to 10,000. So it's not to say that there aren't hedge funds that will do well, but there are a lot of new entrants in hedge funds attracted by the returns, who may not do as well as the prior ones. The last thing is the current movement, currency movements. And here I think it is fair to say that currency movements will be negative for the dollar as a result of sovereign wealth funds. You can already see from this chart that over the last 7 years, the composition of bank reserves has moved substantially against the dollar as euros have gone up. And we would, I think, predict that given the very high percentage of reserves, bank reserves that are in dollars, the sovereign wealth funds would tend to be a more diversified currency. Now there are two important caveats on that. One is that a lot of countries, including Korea, want to keep the dollar strong and keep their currency low for trade reasons. And so if the dollar, through this natural trend, became too low, I think that you would find central banks increasing their dollar reserves in order to strengthen the U.S. currency for trade reasons. The second thing, as we all know, oil is now denominated in dollars. We've had the first contract out of Venezuela, not surprisingly, where the oil contract was in euro. So this is another factor which will have a huge effect on currency. So I would say in general, the U.S. currency, which we've already seen, has declined. And if central banks go more toward a diversified portfolio, or the oil goes to a more diversified portfolio, that will have a substantial effect. But I'm not sure that the trade surplus countries really want that to happen. And may have a reaction on that. So now I come to the third part of my talk, and maybe the most interesting is, so we can see that sovereign wealth funds will be significant players. You can fool around with my statistics and my assumptions, but it's fair to say that they are likely to have anywhere between 7 and 12% of many asset categories. The question is, what does that mean? What does that mean? And let's put this in perspective. Right now, pension funds and mutual funds in the U.S., globally pension funds and mutual funds now have 18 or 19 trillion each. So by 2015, they could easily have 30 trillion. So that's where you need to compare the number of 11 trillion against 30 trillion. So sovereign wealth funds would still be only 1/3 the size of those industries, but they obviously would be more concentrated holders, less diversified. Now, the first question that you get anywhere is, and you saw it in the questionnaires, isn't this just a way in which sovereign wealth funds and the countries that sponsor them are going to take over the defense and energy-related sectors in the United States and Europe? And the answer to that is clearly no. The U.S. has had a law for years called Exxon Florio, and it was recently amended in two important respects. One was the scope of industries that were covered were expanded to include homeland security, whatever that means, and infrastructure, which includes energy, communications. They also added what's called an evergreen, which means that once your transaction is approved, they can still go back and look at you. So every foreign transaction that involves more than 10% of a U.S. company in any of these industries, security-related, energy-related infrastructure, has to pass muster with an approval committee headed by the U.S. Treasury. number of cases, there have been turndowns. There have been formal turndowns, and there have been cases in which people got enough criticism that they decided not to go ahead. Now, there are also specific industries in the United States and in most countries in which foreign ownership is strictly capped. In domestic aviation, at least 75% must be controlled by U.S. citizens. Same thing for shipping. In radio and TV licensing, no more than 20% controlled by foreigners. Nuclear power facilities, no foreign ownership is allowed. And in existing banks, the Fed has an elaborate procedure once you go over 10% to approve or disapprove. So, you come to the next argument, which is that, okay, these very sensitive industries will not be taken over by foreign wealth funds. But won't there be a misallocation of global resources for at least one of three reasons? The first is that people like Sarkozy will always try to create national champions, and that these funds will promote national champions. Then you have to think about how are they going to do that? One way is to make acquisitions, but those are limited by the antitrust laws. Yes, you can get a bigger company, but you can't get a dominant company. And second of all, why don't you just price your products below the market? That will help you grow your company. It will also lose you a lot of money. But even if you continue to lose a lot of money, you would still be subject to anti-dumping and predatory pricing rules. The second argument we hear, which I think in many ways is the most troublesome, is that this is really a guise. Sovereign wealth funds are really a guise for geopolitical dominance. And I think that this is related to two issues. One is Russia. Russia's sovereign wealth fund, to the extent that it buys gas transmission lines, etc., is viewed as very threatening to Europe because they already have a big hole in their gas transmissions. Europe is very capable of requiring special approval in these areas. The other areas are related to Middle East politics. And I don't pretend to be an expert on Middle East politics, but I think people are concerned that some of these Middle East sovereign wealth funds will be used to influence that debate. I don't think it's really a question of the industries, though. I mean, if somebody buys, industry that makes, toilet bowls, I don't think the whole world is going to go, one way or another on the basis of that. Communications is one thing, but I just don't think that these sensitive industries are an issue. And then you come to this general issue of allocation of efficiency, essentially saying that these sovereign wealth funds are not going to invest efficiently. Most of them are very professionally managed, so there's no evidence of that. And most of them are investing instead of putting money in white elephants. If they put money in white elephants locally, then people would be complaining that that's a real waste of money. Another set of arguments have to do with market instability. We have various people saying that we need to have guidelines so that the scale and rapidity with which entities adjust their portfolios will be regulated. Well, if you're that big an institutional investor, and I am the head of a big institutional investor, the last thing you want to do is buy and sell very quickly because it imposes tremendous transaction costs on you. And in general, you tend to invest countercyclically to avoid the herd effect. The other thing is, the reason why people have to make sharp turns and sharp sales is generally because of liquidity pressures. This is what we've seen recently in the mortgage-backed markets. Strikingly, almost no sovereign wealth fund has any leverage, or very minimal leverage, and most of them have no redemption demands either. So it's hard for me to imagine them coming under pressure to sell very quickly. Insider trading concerns. The chairman of the SEC has basically made a set of arguments to say that countries that are the host countries, home countries for sovereign wealth funds, won't cooperate if there are insider trading issues involving the sovereign wealth funds. Well, there's no evidence to suggest that's true, and that hasn't been true in state enterprises. If it were true, then we ought to do something about it. Similarly, they take the view, this Chairman Cox has said publicly, that people from, say, the Korean State Department will slip trade secrets, international secrets to the Korean fund, and then they'll trade them. Again, there's been no evidence that state secrets have been given to these funds. And if there is, if it does happen, then people will quickly realize what was happening, and it would stop. But I think one of the things that's probably a good idea is, and this has been adopted by Norway and by New Zealand, is not to do much trading in your home country, especially if you're in a country because it's a small market. First of all, you want diversification of these things, and second of all, you don't want to get involved with the political issues and other issues of your home market. Now we come to the crux of the matter, which is disclosure. You cannot read a paper on this subject without the word transparency showing up. And who in the room here is against transparency? I want to see. Who is against transparency? No one is against transparency. The question is, what does it mean? Disclosure to whom about what? Now, when we talk about disclosure of profits or investment objectives or these things, we're usually talking about disclosure by the manager to its clients or beneficiaries. Here the beneficiaries are the citizens of the country represented by the Ministry of Finance in most cases. Is there any doubt that the Ministry of Finance is getting enough information about the sovereign wealth fund? Some of these comments are really an attempt to say we need to give the information to the citizens, to the man in the street, or that these governments really aren't legitimate. I believe that those sorts of suggestions really go beyond what is appropriate in a world society. Countries should have a right to have disclosure within its citizens the way it wants. So then you really say what they're really worried about is disclosure to the securities markets. How do we know these people won't be secretly going in and buying up a lot of stock and we'll never know about it? Well, the answer is that because we have these 5% rules, and we have 5% rules that also say if you're acting in concert with someone and you go above 5%, you have to promptly disclose it. And in fact, SWFs do. And then if it's a private company, and you go over 10%, you're still required to do a series of filings with the Treasury. So, what is it that isn't being disclosed that needs to be disclosed? And here I give you a list that was put together recently by the EU. The role of managers versus government officials. I want you to delineate exactly what decisions are made by managers and those by officials. How does the host country regulate the SWF? What are the internal controls and risk management of a SWF? Imagine these questions being asked of a hedge fund or a private equity fund or a pension fund. And the question is, how much does it tell you that's really important to you? What's really important to you? What the risk controls are in management? I can assure you that people at Soc Gen would have told you 6 months ago that they had the best risk controls in the world. And so what good does it do? Investment parameters, your investment objectives. Well, you can state investment objectives in some fairly general terms, you probably get away with it. What's your asset and currency allocation? There's even one commentator suggesting that before a sovereign wealth fund changes its asset and currency allocation, it needs to discuss it with all the other countries in the world. Well then, why would anyone do it? I mean, no investor in their right mind would want to give advanced signals as to where they're going. Quarterly portfolio holdings. This is something that many institutional investors have fought in the world. We now go to yearly, semi-annually related. Finally, we have the argument of backlash. We have Secretary of Treasury Pozen saying that if sovereign wealth funds continue to make big investments in the U.S. and other companies, there will be a protectionist backlash in the U.S. And he may be right, given the sentiment he saw at the beginning, given concerns about globalization. He may be right. But is anyone trying to educate the American people to see what are the good things about these investments? How they help capitalize financial institutions? How they help lower interest rates? How they help some of these financial institutions that are recapitalized in business overseas? But here we have the French President Sarkozy, again, a man prone to very mild words. I believe in globalization, but I don't accept that certain sovereign wealth funds can buy anything here, and our own capitalists can't buy anything in their countries. I demand reciprocity before we open Europe's barriers. Now, interestingly, there aren't a lot of sovereign wealth funds who are trying to buy things in France. But that doesn't bother Mr. Sarkozy. But I think there is a legitimate demand for reciprocity. That if these sovereign wealth funds are going to buy in the U.S. or Europe, those terms should also be open going the other way. So, recently, very recently, last week, we've had some reactions by SWS. There are a few that have said, listen, we're not interested in any investment code, but Abu Dhabi, now Singapore has signed off for their own code. It's a thing about 9 principles, it's fairly general, but they pledge never to use their investments as foreign policy tools and solely to maximize risk-adjusted returns. And on the other hand, they want to be not discriminated against and play by the rules. So, what can we conclude? We conclude that sovereign wealth funds are now important players and are going to become a lot more important players. But we also see that there are a lot of misperceptions. They are not going to willy-nilly buy security-related companies. They will have to be approved. They will not easily dominate strategic industries. They are unlikely to destabilize securities markets and unlikely to trade on inside information without being caught. The realities are, we need a tough discussion, an analytic discussion about disclosure. What are the so-called gaps in disclosure? We want to think what's out there and what are the pieces of information that we don't have that we need. We ought to try to come to an agreement on that. Similarly, I think we ought to come to agreement on reciprocity. Reciprocity is another policy tool that we can use to help reduce some of the tension. Thank you very much. I think we now have time for questions. People want to give answers, then I'll give them.